Welcome to The Explainer. Okay, today we are diving straight into a totally bizarre, wildly profitable, and honestly exploding internet phenomenon, event betting. In the last year alone, prediction markets have transformed from this niche financial oddity into an absolute juggernaut of an industry. They're partnering with giants like the Wall Street Journal and CNN, and they literally saw over $1.5 billion in trades over the Super Bowl alone. But as we pull back the curtain today, you're going to see that this bright future hides some deeply controversial mechanics. All right, let's kick this off with something insiders actually call the Jesus Bond. As of the writing of our source material, there is a contract on a platform called Polymarket that puts the odds of Jesus Christ returning to Earth by the end of the year at a surprisingly high 4%. Now, what this means in practical terms is that if you were to bet $1,000 against it happening, you are virtually guaranteed to make a $40 profit. And hey, if you lose that bet, well, you're going to have way bigger things to worry about than money. The nickname comes from the fact that this trade yields about the exact same interest with basically as little risk as a U.S. Treasury bond. But hang on, this brings up a massive foundational question. When you get income from a Treasury bond, that's just the government paying you interest because you loaned them money. But who exactly is paying for the Jesus bond? If someone is winning easy money on a seemingly trivial or, let's face it, guaranteed bet, whose wallet is that cash actually coming from? If you're a casual trader, this is the central mystery you need to solve before you ever place a bet. Section 1. The rules of the game. Trading probabilities, not standard casino bets. So to solve that mystery, we first need to understand that legally speaking, these platforms occupy a really fascinating regulatory gray zone. They aren't overseen by the Securities and Exchange Commission, and they don't fall under state gambling laws either. Instead, the U.S. government classifies them as derivatives markets, overseen by the Commodity Futures Trading Commission. You aren't placing a casino bet, you're trading probabilities. Here's how it actually works in practice. Instead of a traditional wager, you buy yes or no positions, and the price reflects what the market thinks the likelihood of that event is. For instance, let's say there's a contract on whether Taylor Swift will get married in Tuscany. If a yes share costs 30 cents, the community believes there's a 30% chance it happens. If you buy 100 shares for $30 and she does get married there, each share resolves to $1. You walk away with $70 in profit. But here's the kicker. You don't actually have to wait. If Swift simply mentions in an interview that she wants a European wedding, the price might jump to 70 cents right then and there. You can sell your shares early for a $40 profit. The market dictates the price in real time based on sentiment and breaking news. Section 2. The card sharks. The undeniable pattern of the insider threat. Trading these probabilities sounds like a fun, interactive way to follow pop culture or politics, right? But this lax regulatory environment has fostered a much darker reality. Because when there's real money on the line and minimal oversight, people with privileged information are absolutely going to exploit it. And this isn't just a theoretical risk. It is a heavily documented pattern. Just look at these specific trades. In October 2025, highly profitable bets were placed on long shot Maria Corina Machado to win the Nobel Peace Prize literally hours before the announcement. Late that year, someone made a wildly risky but super lucrative bet that musical artist David would be Google's most searched person. Early 2026 saw a trader make over $400,000 betting on Nicolas Maduro's ousting mere hours before the U.S. military intervened. And then, in the spring of 2026, an unusual flurry of bets correctly predicted a sudden U.S. and Israel strike on Iran. There was widespread speculation that these trades were made by actual insiders. We're talking a Google employee, a Nobel Committee member, or a Pentagon official, leveraging non-public information for a massive payday. Section 3. The ethical paradox. Accuracy versus market fairness. Now, in traditional, regulated stock markets, this kind of insider trading is strictly prohibited because it completely destroys market integrity. But in the world of prediction markets, we run headfirst into a mind-bending ethical paradox. Proponents of prediction markets actually argue that insider trading is a feature, not a bug. Yeah, you heard that right. They rely on two main concepts, the wisdom of the crowd and financial incentives. They argue that when people have real skin in the game, they put aside their personal biases. You don't just vote for who you want to win, you bet on who you know will win. Therefore, if you allow insiders to trade, you are financially incentivizing the people with the absolute best, most accurate information to reveal it to the market, which creates flawless forecasts. But the counterargument is totally devastating for the casual trader. If a market operates as a zero-sum game, allowing an unfair advantage completely damages market integrity. If everyday users know they are betting against people who essentially already know the future, they'll lose all confidence, and they're going to take their hard-earned dollars elsewhere. And what's truly chilling is hearing this straight from the top. Listen to this. The 28-year-old CEO of Polymarket stated, "What's cool about Polymarket is that it creates this financial incentive for people to go and divulge the information to the market." Think about the implications of that quote for a second. The leadership of these platforms is actively praising the idea of individuals leveraging privileged, inside information for personal profit. Basically, they view your lost bet as just the necessary cost of acquiring accurate data. Section 4. The loser creation machine, the zero-sum reality of your first bet. All right, so this brings us to a really harsh truth that rarely gets talked about amidst all the hype surrounding these platforms. If you are a casual trader considering making your first bet, you need to understand the brutal foundational math of the ecosystem you're stepping into. It is a loser creation machine. Let's break this down by comparing it to something you might be a bit more familiar with. In the traditional stock market, it's non-zero sum. If you invest in a company and that company innovates, grows, and creates jobs, the overall economic pie gets bigger. Everyone can win. But prediction markets are strictly zero sum, exactly like a game of poker. For you to win $1, another player must lose $1. There's no economic growth being generated. It is merely a transfer of wealth. Which brings us right back to our early question, who is paying for that $40 Jesus bond profit? Well, it's the people who bet that he would return. Even if they are true believers, their money isn't getting raptured. It's going directly into the winner's pocket. Every winner requires a loser left holding the bag. And that dynamic, that creates the fundamental paradox of the entire system. The catch-22 of prediction markets. See, the big winners on these platforms take it very seriously. They are professional statisticians and insiders. But these pros won't sit at the table if the pot isn't big enough. To get accurate forecasts, you need these experts. But to pay these experts, you absolutely require a constant, never-ending supply of amateurs, just regular people, to take the opposite side of the bet and lose their money. If the amateurs realize they're totally outmatched and leave, the pros leave too, and the whole market collapses. So how exactly does the industry solve this catch-22? Well, through advertising and culture. Just like sports betting apps pummel young men with commercials, prediction markets rely on this massive ecosystem of blogs, podcasts, live streams, and subreddits. They build hype, they foster a sense of community. But here is the secret. Much of this content is coincidentally produced by the pro traders themselves. They have a distinct financial interest in keeping casual bettors optimistic. Their goal is to constantly entice fresh capital, new noobs, to replace the players who finally wised up or just simply ran out of money. It is a highly sophisticated machine designed to feed the sharks. Section 5. The fold. Should you place a bet? Okay, so we've seen the insider trading, we've explored the zero-sum math, and we've weighed the cost of market accuracy against plain old fairness. So should you, the viewer, actually place a bet on one of these platforms? Look, while the government might officially call these event contracts derivatives, the absolute smartest thing you can do is to treat it exactly like gambling. If you want to bet on pop culture or elections just for fun, go right ahead, but play in strict moderation and only ever play with money you can actually afford to lose. Because remember, you aren't just betting against the house. You are sitting at a virtual table with highly informed card sharks and professional statisticians who literally need your money to survive. I want to leave you with a classic poker adage that perfectly captures the reality of prediction markets. If you look around the table and can't tell who the sucker is you. So the next time you see a really tempting bet online, ask yourself, do I actually have the inside edge here, or am I just funding someone else's payday? Thanks for joining me for this explainer, and keep your eyes open out there.